this stock market masterclass webinar. So I'll just go ahead and start sharing my screen. So that's the topic of the course, the Nigerian Stock Market Masterclass. By way of overview, these are the things that we're going to go through. We'll go through an introduction. We'll talk about the attributes of a good stock investment. We'll look at how we can assess company financial performance. And we'll also look at issues related to valuations, and we'll take a few case studies. Now, there was another webinar I did recently, which speaks to the issues surrounding taking advantage of the opportunities presented in this stock market meltdown and crisis. So I'll take a few slides from that webinar as well to discuss with you. So in a sense, those of you who are attending now, in a sense, you'll be getting two for the price of one. Like Funmi mentioned earlier on, intermittently, I will pause and take questions. So now, by way of introduction, for most people who are thinking of investing in the stock market, one prominent or one important question for most of them is, what if I invest in the Nigerian stock market and the share price falls? For the slightly more discerning investor, they will say, what if I invest in the Nigerian stock market and the Naira is devalued? We'll endeavor to answer these two questions as we go along. But there is something I'd like to put out there right away. There is something I'd like to put out there right away that addresses the issue of what if I invest in the Nigerian stock market and the share price falls. So I'll go ahead and share another screen now. Now, what this screen does is that it models investment return. The figure you see in red at the bottom here is the annualized return on investments, depending on four important parameters: what the share price is today, what the expected dividend is 1 year from today, what the annual growth in dividend is, and then what the share price is going to be at a future date, in this case, 10 years. So what I'm going to do now is that I'll use a very popular company just as an illustration to answer that first question: what if I invest and the share price falls? Now, I'll use Guarantee Trust Bank. Now, of course, what I want to illustrate is a principle is not only applicable to Guarantee Trust Bank. Okay. Yesterday on the Nigerian Stock Exchange, the share price of Guarantee Trust closed at 18 Naira 85 kobo. Well, not yesterday, day before yesterday, because yesterday was a public holiday. Now, what this shows is that, what this assumes is that somebody purchases that share at 18 Naira 85 kobo. Now, in this example or model that I'm using, I'm going to assume that the person invests over a 10-year period. And you know, the concern of most investors, what if I buy at 18 Naira 85 kobo and over time the share price drops to 10 Naira, as an example. So if the share price drops to 10 Naira, the question is, how much dividend do we expect in 1 year's time? What's the annual growth in dividend do we expect? The immediate past year, the year ended 31st December 2019, Guarantee Trust paid a gross dividend of 2 naira 80 kobo, which net of taxes amounted to 2 naira 52 kobo. If I take the view that Guarantee Trust will be able to grow its dividend at about 10% per annum over the next 10 years, which is a fairly conservative view, because if you look at the track record of the company, they've actually been able to do better than that. So I'm going to assume the 2 naira 52 kobo that they paid net of taxes this year grows by 10% next year. So that comes to 2 naira 77 kobo here. And then the estimated annual growth in dividend here is 0.1. Now, what this shows basically is this. If you purchase Guarantee Trust at 18 naira 85 kobo, and the company is able to grow its dividend by 10% per annum starting from next year for the next 10 years, and the share price actually falls to 10 naira in 10 years' time, your annual return on investment is actually 18.6% per annum. 18.6% per annum is the return. Now, I'm going to assume maybe the unthinkable, that the share price falls to 0. If the share price were to fall to 0, then the return on investment is going to be 16.2%. I'll just go over this again. What this says is that if you purchase GT Bank at 18.5%, and the company is able to grow its dividend by 10% per annum over the next 10 years, even if the share price were to fall to 0, the investor will get an annualized return of 16.2%. Instinctively, this is something that may be strange to a lot of people, because they just automatically assume that once share price falls to 0, I've lost all my investment. But the point I'm trying to make here is that your investment return is not only on the share price at the future date, but also is inclusive of the dividend that you're able to collect over time. And the higher that dividend is, the more the return on investment, even if the share price is 0. So just to illustrate that, let's assume that the dividend growth per annum is about 14%. I'm typing in 14% now. You'll see the figure in red jumps to 19.6%. Now, if we take some less extreme assumptions and just sort of assume that in 10 years' time, the share price can be something like, let's say, 75 or let's say 85 naira. Under all of these assumptions, the return per annum for the investor turns to 28.4%. And this is 28.4% per annum, every blessed year under this scenario. Now, the other thing I would like to put out there very, very quickly is that this return that you are seeing in red actually is very dependent on purchase price. So again, I'll use this example. Earlier on this year, when America had bombed, or when America was having a spat with Iran and oil price started to rise, this same bank had actually traded as high as 34 naira per share. And obviously there were people that purchased at 34 naira per share. So under these same assumptions, you can see that at 18.85, the return is 28.4% per annum. So I'm just going to assume that somebody bought at 34. You can see the return. So your investment return when you're investing in stocks is very, very much dependent on your purchase price. Is dependent also on the dividend that the company is able to pay over time. Now, I'm going to make another assumption that maybe this share price still has further down to go, because some people are of the opinion that given everything that is going on in the Nigerian economy, we may still see further declines. Assuming we see further declines and this share price goes down to 12 naira and somebody buys at 12, I want you to see the figure in red. The investment return becomes a whopping 38.5% per annum. And even if the share price had to go to 0 in 10 years' time, provided all of the dividend are paid, the investor actually makes 28% per annum. I mean, just to put things in perspective, 28% per annum is way, way above inflation. And 28% per annum, in all likelihood, will also be way, way, way above Naira devaluation on an annual basis. I mean, it's almost impossible for Naira to be devalued at 28% per annum on an annual basis. Now, if that were to be the case, if I start from 400 Naira today, if Naira were to be devalued at 28% per annum for 10 years, that means that the exchange rate in 10 years' time will have to be 4,700 Naira. In 5 years' time, the exchange rate, if it devalues at 28% per annum, in 5 years' time, it will have to be 1,375. Okay. So this is the first thing. This is the first thing I would like to put out there. Because like I said, the concern of most people is that what if I purchase and share prices fall? Again, just for the sake of emphasis, a lot of value is not only in the share price, but also in the dividend that is collected and in the annual growth of that dividend. So what I'll do is I'll go back to the PowerPoint slide. Okay. Now, the next thing that I would like to do is to draw a contrast between stock investing and stock trading. Because some people confuse the two terms, and both of them are like night and day in terms of contrast. Now, when somebody is investing in stock, the person typically would have a medium to a long-term orientation, whereas somebody who is trading in stocks will have a short-term orientation. Medium to long-term orientation could be anywhere between 2 to 5 years, whereas short-term orientation could be anywhere between, let's say, 1 day to a few months. Now, an investor typically will focus on the company. So as an example, if somebody is investing in the stock market and the person is investing in, let's say, Nigerian breweries, the focus of an investor is on how well that company, Nigerian breweries, is doing. Whereas for somebody who is trading, the focus of that person is on market prices and the momentum of the market prices. It's not so much the underlying companies as much as the price movements in the market. For somebody who is investing, the person is quite concerned about sustainable dividend income from the investment. Just like if somebody were to purchase a house for rental purposes, your concern would be that the house is tenanted and that you're getting your rental income. So the equivalent for stocks is that you are getting sustainable and growing dividend income. Now, for the stock trader, on the other hand, the focus is on short-term price movements. The person is not as concerned with stable dividend or anything. He might not even hold the stock long enough for dividends to come. Now, the fourth distinction is that the person who is investing, as opposed to the person who is trading, is looking to buy the stock at a price that represents value for money. For the stock trader, typically the focus is on buying when market sentiments are positive and price momentum generally is on the upward trend. And the whole objective of a trader is to go in and come out very, very quickly and make profits while trading. Now, what we'll be talking about in this stock market masterclass, we're going to focus heavily on stock investing. For some people, that may be a bit boring, but a lot of times that is where a lot of sustainable long-term value lies. I'm sure that a lot of you are familiar with Warren Buffett. Warren Buffett is a master of stock investing, not stock trading. In fact, what he says, he has a mantra that says that he normally purchases in the stock market when people are fearful. He says that he becomes greedy as in buying shares when people are fearful. But when people are greedy and are piling into the stock market, that's when he becomes fearful. Because what tends to happen is that a lot of people, particularly retail investors, they tend to pile into the market when the market is on an upward trend. But as you are going to see as this webinar continues to unfold, is that a lot of times there is fundamental value that you can derive and lock in when you buy when prices are down. And that locking in can actually be for a very, very long-term period. Now, I'd like to pause at this point and take maybe questions, if there are any questions. I like to pause and take questions. So I've gone into the chat box now to see whether there are any questions. Okay, I see a couple of questions here. I see one in particular. It says, so what are the factors that determine dividend growth rates? There's a question in the chat box from Ola to everyone. So what are the factors that determine dividend growth rates? As you are going to see shortly, one of the things I would normally say is that when you're thinking of investing in any stock, one of the parameters you should look at is what has been the track record of the company. What has been the track record of the company? So for example, when we're talking about dividend growth rates, I would like to see what the track record of the company is. Another thing that determines dividend growth rates, a number of factors actually. One is track record. Another one is the ability of the company to improve its profits over time. Again, I'll be looking at track record. Now, another thing is that the amount of earnings that is retained on the business, the more of profit, you see, if a company makes a profit of 100 million, the company may decide to pay, let's say, 60 million out as dividend and retains 40 in the business. The more money that the company retains in the business, all other things being equal, the more the company is able to grow its dividend. If somebody says, good morning, is annual return different from dividend payouts? Dividend payout really is the amount of money that is actually paid to the investor, usually on an annual basis or twice on an annual basis. Why is share price important? That's another question. The reason why share price is important is because that is the price at which you are making the investment. I mean, think of it like this. Let's say there's a twin duplex that is going for sale. A particular investor is able to buy one twin of the duplex for 25 naira. Another investor around the same time buys the same twin duplex, maybe just down the road, for 45 naira. Obviously, the person that purchased for 25 million or whatever will then have a better return on investment. Someone says, where can we read about companies' track record? The annual reports of every Nigerian company, if you go to the very, very back of it, you'll actually see like a 5-year track record of that company. So you actually see, you can get for as long as you want. It's not limited to 5 years. Okay. Someone says, are there benefits to purchasing directly or using a stockbroker? You really have to use, it's either you use an app or use a stockbroker. But even when you use an app, you are still going through a stockbroker. you cannot go to the floor of the exchange as an individual, even if you are Dangote, to say you want to go and buy shares. Everybody must go through a stockbroker, either physically or electronically. Okay.
I think I'll just walk you through some other questions, Mr. Agusto. So someone says, is stock trading profitable in the Nigerian stock market?
I mean, stock trading comes with its own skills and its own risks. And I would say that in any market, not just Nigerian market, it can be profitable, it can be unprofitable. Because you really need to understand the dynamics of the market for you to be able to trade profitably. Another thing I can tell you for free is that anybody who is trading in stocks, there'll be times that the person will make losses, there'll be times that the person will make gains. The only expectation is that, well, you hope to make gains more times than you make losses. One other thing I may add, though, is that if you want to trade, you really need to perfect the act of buying low and selling high. Now, it may sound simple, but the truth is that when the market is going down, you don't necessarily know when it has actually bottomed out. But there are all sorts of tools that people use to gauge the market. And for those who are experienced and knowledgeable traders, they actually do make money from trading. There are some people who do day trading. Day trading simply means that you buy and sell within a day. They don't carry their position to the next day. But like I said earlier on, a lot of what we're talking about here really is going to be about investing, because that one is more predictable and that one can be more profitable on a sustainable basis.
Okay, so I'll just take two more questions. Umfon says, if a company is liquidated, so she assumes that for a share price to go to zero, that means the company is liquidated. Will you get your dividend as indicated in your analysis?
Usually by the time a company is getting to the point of liquidation, you ain't going to get nothing. Although it's still possible for a company to be liquidated and shareholders to get some money. But usually 9 out of 10 or 8 out of 10 cases, by the time a company gets to the point where it is being liquidated, you get zero. And I'll give a few examples even from the Nigerian Stock Exchange. For example, if you had invested in the shares of Skybank, Skybank has ceased to exist now, and the shareholders got zero. Zero as in zero. On the other hand, if you invested in Intercontinental Bank, if I remember correctly, that's the one that was acquired by Access Bank, right? The shareholders did not get zero, but what they got was just a minuscule percentage of their investments. Let's just say for the sake of illustration, somebody invested at, let's say 35 Naira. And when Access was going to acquire Intercontinental, the equivalent price, because when Access Bank acquired Intercontinental, what they did was that they gave some Access shares to shareholders of Intercontinental, but it was such at a low rate that effectively somebody who invested in Intercontinental actually lost like 90% of their investment. We'll talk about investment risk later. So I'll just move on.
So I want to clarify that question and then take one more question. Because she was asking, like, you made an assumption that if the share price goes to zero. So are we saying that when the share price goes to zero, that company is liquidated? Most likely liquidated.
Well, most likely for the share price to be zero, that means that investors are not seeing any value. Okay. But the point I was trying to make is that in the example I used a company that is alive and doing well. Okay. And I'm saying that if over the next 10 years you get dividends, as indicated in the assumption, right? But by some stroke of bad luck, the company now becomes totally liquidated in 10 years' time. That even under such a scenario, you still have made a decent return on your investment. You said one more question to me. Over to you.
Yes, so I think most of the questions I see is about how to get company reports, financial statements, and how to get, how to read financial statements. I think that's a major concern for most people.
Okay, let's just move on. We will come back to those ones. Let's just move on. Okay, let's now look at the attributes of good stock investment. In other words, how can I make a good stock investment? I have 4 points here. The first one is a company that is well governed. Second one is a company that is well managed. Third one is a company with a very good performance track record. And then the fourth one is an investment or a stock investment that is purchased at a share price that represents good value for money. Let's go through each one. A well-governed company is a company that has very good institutional checks and balances. As an example, the board provides proper oversight to management. As an example, management themselves, they oversee the affairs of the company in a honest and in a competent manner. Now, such a company will be usually managed for the benefit of the stakeholders. It is unfortunately but true that there are companies in Nigeria that are managed for the pockets of either the management or the board. So one really needs to be careful. If I may use a Nigerian expression, you need to shine your eyes. So now that there's a slight distinction between a well-governed company and a well-managed company. A well-managed company speaks really to efficiency in the utilization of resources. Typically, well-managed companies, they will be one of the better companies or one of the more profitable companies within their industry or sector. So for example, if you are to take a sector like insurance, a sector like agri, a sector like food and beverage, cement, or whatever sector you take, right? Typically, you will discover that the companies that are well managed on a relative basis compared to their peers, they tend to do better. Now, there are different sources of information, assuming that you are doing this analysis yourself. One is that stockbrokers typically make investment recommendations, but you can even go beyond the investment recommendation of stockbrokers, particularly if you know people who are working in some of these companies or some of this industry. As an illustration, let's say I have a friend who has worked in the telecoms industry for, let's say, 10 years or so. The person will probably, or in all probability, be able to give me information about the different players in the industry and their relative strengths and weaknesses that I may not have, let's say, because I'm a medical doctor. Okay? So what I'm trying to say is that in addition to annual reports, in addition to investment recommendations of your stockbrokers, in addition to articles on the social media or Nairametrics or whatever, you can also do your own independent assessment. Okay. Like I said, the track record is extremely important, and I'm talking mainly about track record of performance. You can get that in financial reports. All Nigerian annual reports, they are mandated to carry five-year financial history. So you can actually see how the company has fared in the last 5 years. If you want to extend your analysis to 10 years, all well and good. Just lay your hands on the current one you get 5 years back. Lay your hands on the one that is 5 years ago, you get a further 5 years back, and you have 10 years. The fourth point here is that investors need to be careful. Investors, they need to be careful to ensure that when they are buying, it's the price at which they are buying represents good value for money. Now that's a bit technical. I'll touch on it a little bit during this course, but it's not something that you can fully grasp unless you have a very strong financial background. I'll try and explain it. You see, when something is value for money, the main value in a company, really, or in investing in a company, is the future profits and the future dividend that you're going to be entitled to. So when we're talking about purchasing at a price that represents good value for money, we're talking about the price you pay today versus the potential for future dividend and future profits. There has to be a sync between those two for it to represent good value for money. Maybe if I use a real estate example, it probably will drive home the point. most of us are familiar with the Nigerian real estate market. If I buy a property in the Nigerian market today for 100 million, the expectation is that I should be able to collect rent of 5 million per annum, or maybe 6 million per annum. If I purchase a property for 100 million and I can get rent of 10 million per annum in Nigeria of today, that's fantastic. That's very good value for money. On the other hand, if I purchase a property for 100, and I'm using 100 because it's easier to think percentage when you're, if I purchase a property for 100 million and all I can get as rent is 1.5 million, I'm sure you don't need to be a financial analyst to tell me that, Oga, that investment is not very good. So that's a sort of rough illustration of what I mean when I talk about an investment being purchased or shares being purchased at a price that represents good value for money. Okay, there are certain stock market concepts that I would like to explain. Okay, we talk about, there are issues of, okay, what is share price? Share price is simply the price at which one share of a company is being sold, or is being offered, or is being traded. Just as an illustration, let's say you read the newspapers and you see that Guinness is quoted at 24 naira 50 kobo. It means that if you want to buy one share of Guinness, it is 24 naira 50 kobo. Now, in the Nigerian stock market, share prices, or in any stock market, share prices move from time to time as a result of demand and supply. So if demand is more than supply, generally the prices will go up. If supply is more than demand, generally prices will go down. Now, in terms of maximum daily price movement on the Nigerian Stock Exchange, share price can either go up or come down by a maximum of 10% a day. So if let's say last Thursday, the share price closed at 100 naira, it means that when the market opens on Tuesday after the Easter break, the maximum that share can trade is 110, and the minimum it can trade is 90. But share price movements, generally, they reflect demand and supply. Now, you'll notice that in the last, since COVID-19 and its attendant impact on oil prices, share price in the Nigerian stock market have been going down significantly. And that's because with everything that COVID-19 represents and oil prices, a lot of investors are saying to themselves that, look, with oil price collapse, the Nigerian economy is likely to hit some serious headwinds, and we're likely to have a situation where the economy may even enter into recession. Companies' profitabilities will be challenged, Naira will be devalued, blah, 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 blah. All I want to do is sell and build. Market capitalization, on the other hand, is the entire worth of the company at current market price. So if a company has, let's say, 2 billion shares in issue, right? And the share price of that company is 5 naira. The market capitalization of that company is 2 billion times 5 naira, and that comes to 10 billion naira. So the market capitalization is the worth of the entire company based on the price quoted on the stock exchange. The worth of the entire company based on the price quoted on the stock exchange. So I'll move to the next slide. One of the most important issues to an investor, one of the most important issues to an investor is the profitability of a company. Now, a lot of the things we are going to discuss from this slide, they have to do with profitability. The first one is return on equity. Equity is what we call, or another word for equity in a company is the shareholders' funds. The shareholders' funds in the company is the excess of the naira value of the assets of the company over its liabilities. As an illustration, let's say the assets of a company are worth 100 million and the company has liabilities of, let's say, 28 million. The company has total assets of 100 million. The company has total liabilities of 28 million. It means that the equity or the shareholders' funds of the company is 100 minus 28, and that's 72 million naira. Now, what return on equity measures is how much profit after tax is the company making relative to the shareholders' funds. So in this example, where the shareholders' funds is 72 million, if, as an illustration, the company makes a profit of 36 million naira after tax, 36 million after is half of 72. So the return on equity will be said to be 50%. I'll just go over that again. I said that equity in a business is the excess of the assets of the company in monetary terms over the liabilities of the company also in monetary terms. So if a company has 100 million of assets and the company has 28 million of liabilities, it means that the equity of that business is 100 minus 28. 100 minus 28 is 72 million. That equity is another word for shareholders' funds, because the company has assets of 100 million and has liabilities of 28. The difference between the two is 72, and it belongs to the shareholders. So the real question for the shareholder is that in this business where shareholders have 72 million, how much profit is the company making? So if the profit is 36 million, like I said, the return on equity will be 50%. Of course, the higher that return on equity is, the better it is for shareholders. And the lower the return on equity is, the worse it is for shareholders. Now, the second point there is about earnings growth. Now, these earnings, when we say earnings now, what we mean is profit. That's the simple whatever. Now, it is desirable and very good when you invest in a company that grows its profits periodically. The reason why growth in profit is important is that the more the profit the company makes, all other things being equal, the more the dividends that they will give you. The other thing is that you also want to make an investment where your earnings or your profit is growing at least with the inflation. Because if you have an investment where your earnings is not growing with the inflation, it means that in real terms, the purchasing power is declining. As an illustration, let's say, again, I'll use round sums as examples. Let's say inflation rate in Nigeria is 10%, right? If I invest 1 million naira, right? 10%, or let me even say, if I invest 100 naira, right? It means that at the end of 1 year, if I get a return of just 5%, it means that my funds at the end of 1 year will be 100 naira plus 5 naira, that is 105, right? But if inflation is running at 10% per annum, I would have made a loss, in the sense that by the time we adjust the 105 for inflation, it is actually less than the 100 naira that I started with. So again, it's important that investments, particularly long-term investments, should grow at least the rate of inflation. Earnings per share is the profit per share. In other words, out of whatever profits the company makes, when you divide it by the total number of shares, you then get the earnings that is attributable to each share, to one share. Let me digress a bit, but it's an important digression. One of the things that people say about Nestle, one of the major companies on the stock exchange, they normally complain that the share price is too high. One of the reasons why the share price is high is because the earnings per share, and usually the dividend per share, is also very high. For the year that just passed, right, The total amount of dividend that Nestle paid for each share was 70 naira. So when a company is paying 70 naira as dividend, it is understandable that the share price will be high. So earnings per share is extremely important to the investor, and dividend per share is also important. What happens typically is that for most companies, let's say they make earnings per share of proportion of this 10 naira that will be paid out as dividend. Just as an illustration, let's say earnings per share in flour mills, let's say it's 10 naira. I'm not saying it is, I'm just saying let us say it's 10 naira. And let us say flour mills then pay shareholders. For that year that earnings is 10 naira, they pay shareholders, let's say 6 naira 20, 6 naira 50 kobo as dividend. What it means is that the difference between 10 and 6 naira 50 kobo, which is 3 naira 50 kobo, what it means is that flour mills is reinvesting that money in the business for profit growth and for further benefits of the shareholders. So these are very, very important profitability assessments. Return on equity, the rate at which the profit is growing, the profit per share. Like I said earlier on, earnings is the same as profit. And then dividend is what is actually paid out. That's the one you get a credit alert in respect of. I've mentioned a lot of financial whatever, so I would like to pause at this point and take questions, because at times people tend to have questions when you're talking about financial issues. So I'd like to take questions. Tommy, if you don't mind, you can just read out the questions.
So there's one question.
And then we go.
Yeah, there's one question. It says, please re-explain the return on equity.
Which I think I've done. I think I explained it twice. I don't know whether that question came before or after.
I think it was because you mentioned a lot of numbers, so some people just missed out on what exactly you meant by return on equity.
Okay, I'll do that right away. Return on equity is for every naira that is invested or that represents shareholders' funds in the business. Or let me even make it very simple. Let's say you start a business today with 100,000 naira. And at the end of the year, that is your equity in the business. And at the end of the year, you make a profit of 45,000 after all expenses. Your return on equity is 45,000 naira divided by 100,000 naira, and that's 45%. So the return on equity is the profit divided by the amount invested in the business.
Okay, so this also assumes that that's what that can also be like capital, initial capital.
Yes, that's also the capital, yes.
But for companies that are already on the stock market, it's more like what they already have in their shareholders' funds.
Yes.
So it's more like cumulative, so that we just make it, people understand that. Okay, so someone says, what is the relationship between return on equity and earnings per share?
The thing is that the higher the return on equity, that means that the higher the profit. The higher the return on equity, again, all other things being equal, the higher the earnings per share will be. Because earnings per share is profit per share.
Yeah, so let's assume using the same numbers that you use, the profit was 45,000 naira and the initial or the share equity was 100,000 naira. So to get earnings per share, it will really be 45,000 naira profits divided by the amount of shares the company has.
Absolutely, ma.
So if the company has 1 million shares, it will be 45,000 naira divided by 1 million shares.
Absolutely, ma.
All right, so please let me know if that explains it, Tokwe. So you understand the relationship between return on equity. So return on equity is really measuring what profit the company has earned compared to the capital that was invested in that business. While earnings per share is comparing the earnings as the profits and the amount of shares. You know, every company has an amount of shares. So if the company has 1 million shares, 100 million shares, you know, so if a company has 200 million shares and the profit is low, you know that the earnings per share will be low, you know, so that's just a way to show you the relationship.
One thing that I also like to add, for those who may not necessarily fully understand the technicalities, there are still additional slides that I have that will really simplify the issue. Because the objective of this course is to bring it down to the level of the non-financial person in making investment decisions. Yes. Of course, granted, it's not everybody that will have the skills to make those decisions, but at least you know what questions to ask. Please go on, Tommy.
So there's another question on the fact that financial statements for Nigerian companies are always mostly untrue. So I guess the real question is, if you are trading on the stock exchange, does the SEC, the regulatory authority, review their statements to an extent? Because we assume that if you're a public company trading on the stock exchange and you're doing and making your reports, the financial statements should at least meet some sort of international standard. So if we still have the issues of public companies having that, how exactly do we navigate and know the real companies? So I really understand what Victoria is saying.
Yeah. I agree with that person, actually. It's not all financial statements that are published that are reliable. I'll provide some guidance. On the Nigerian Stock Exchange, there is something called, there are several sub-indices. Sub-indices simply mean subsectors. For example, you have something called NSE 30. NSE 30 is the group of 30 companies 30 biggest companies on the Nigerian Stock Exchange, right? Another subgroup, or another subgroup, if I may use that expression, is NSE Pension. NSE Pension represents about 40 or so companies that pension funds are allowed to invest in. So if you're a pension fund, by regulation, you are precluded from investing outside of this. So by the way, there are close to about 200 companies that are listed on the Nigerian Stock Exchange. Now, why am I talking about this? I'm talking about this because some more stringent parameters have been applied in selecting, particularly something like the NSE Pension. So any company you find on NSE Pension, the parameter for selecting them is more stringent than the 200 or so companies that are listed on the exchange. So one of the things you may want to do, if you are doing it by yourself, is that you can start with the NSE Pension, which is just about 40 companies. And even within those 40 companies, you can actually, if you want, whittle them down to another 20 or maybe even 15. And one of the parameters that you can use to whittle them down is some of the things I've mentioned earlier on, like track record and so on. But you can also use what I refer to as industry position. Who are the leaders within this industries, right? So that way, even if you are a lay investor, so to speak, there is some guidance that all of this will provide for you. Because if pension funds are allowed only to invest in this, and they represent just about 25% of the market, there must then have been some parameters that these companies have met that other companies have not met.
Okay, so thank you, Mr. Agusto. Just to reiterate.
In addition to that, please also consult your stockbroker or your investment advisor.
Okay. Okay.
Yes.
So I just wanted to reiterate that point, so that while we have over 200 companies on the stock exchange trading, there's a group of companies that have been recommended for the pension sector. And we all know that.
Recommended though, mandated. When I say mandated,
okay.
You cannot invest outside those companies.
Yeah, and that's because the pension sector is very important. They don't want them to lose investor funds.
Our pensions.
Our pensions. So
and some of us are closer to retirement.
Yes. So that shows you that the 40 stocks selected for that selection are definitely stocks that have been reviewed for some of the indicators that you have shared with us today. And then you're saying you can whittle that down further. Yes,
you can whittle it down further.
Okay, so
say that.
For members of the Green Club, we're going to do that. So we will do that for you. So let's just move on to the next question. So it says, somebody says explain earning growth. I think that is, it's just if the company is growing
profit growth.
Yes,
the company is growing profit. Yes.
Ola says,
if I may just speak to that, I'm sure that every investor would like to invest in a company whose profit is growing, not whose profit is declining.
Yes.
I mean, that's just intuitive.
Yes.
Okay, thank you.
Ola says, what are the indicators of solid governance? And I think this is very important because I think if you pick a company like Owando, most people didn't understand that the governance, the corporate governance was in shambles. So if you can just speak to that, really.
It's a bit tough because some of it is whatever. But one of the things I would strongly recommend, we have friends working in a lot of these companies, right? If somebody is really your friend working in some of these companies, they will tell you how things actually work in that company, right? So I would say, in other words, don't rely only on the official information. Nobody puts out official information to say we have bad governance. But you really have to go behind the scenes to understand which companies are actually well governed or whatever. Another indicator, particularly when you have insiders, ask them, how do things work in this company? The board of directors, do they really truly have oversight of over this company? There are some companies, unfortunately, so because the board is supposed to control management, there are some companies that the management is controlling the board. There are some companies that contracts are awarded for the benefit of management and board. Those are inside kind of information that can help you. Another thing I will also rely on is, one of the things I mentioned earlier on is track record. Another one I will rely on is long-term track record. Because if a company is not being well governed, whilst you may be able to cover it for maybe a few years, by the time I look at your 10-year record, right? Maybe for some companies, even longer, I will see an indication that, look, all may not be well or all is not well with this company. So what I would strongly recommend in terms of governance, particularly from the Nigerian perspective, talk to those who are really, truly your friends, who are working within those companies. They will tell you the way it is.
Well, Mr. Agusto, I understand that, but you're Oga at the top, you have friends in those companies. We are just growing, but we will try as much as possible. I
have my views, but I will not share my views on the public forum.
No problem. So we'll take 4 more questions around this section of. Lesson says, can you explain earnings per share and dividend per share? I know we've explained earnings per share, so I think she just wants us to compare it to dividend per share.
Earnings per share is how much profit the company has made for each share.
Yes.
Again, just as an illustration, let's say, I'm trying to look for one that I can remember. Let's say Dangote Sugar. I think last year, for every 1 share, they made earnings of 1 naira, maybe about 60 kobo or so. It's just the amount of the profit divided by total number of shares. Whilst the dividend per share is the amount the dividend has actually paid out. Earnings per share is not paid out to the investor. It's the dividend per share that is paid out. That's when you get the alert for in your account.
And these indicators are usually shared. I think for most stockbroking newsletters, they share them. You don't have.
They share them. It's also in the annual reports of the companies.
Yes, so you can
also go to Bloomberg. You can go to Bloomberg website, and you'll see these things
and compare. So you can compare the earnings per share of a company versus. So basically, dividend is showing you how much you've paid out from the earnings they've earned per share.
Absolutely, yes.
Yes. So next question, is inflation rate a consistent factor to always check out while making investments? Based on the fact that we live in a country like Nigeria.
Inflation is important. And the truth is that inflation would normally is normally volatile. Our research data over the last 20 years shows that in Nigeria, it has averaged about 12% per annum. There are times it goes up, there are times it comes down. But the long-term average, at least for the past 20 years, is about 12% per annum. So what that really means is that if you make any investment in Naira, and that investment is not growing by at least 12% per annum, you are making a loss on an inflation-adjusted basis.
So
and just to put things a bit in perspective, if something is growing at 12% per annum, right? If you compound that 12% per annum growth, the investment needs to double every 6 years. So if you invest 10 million naira this year, if it just barely keeps up with inflation in 6 years' time, that 10 million has to be 20 million. So if it's less than 20 million, you have actually lost money in inflation-adjusted terms.
So basically, that means we should stay away from the money market for now, right?
You see, you can be in the money market for a short time. In other words, if somebody says treasury bills is 5% and you're there for 90 days, that's not a problem because you are probably there for 90 days because you need your liquidity after 90 days.
Yeah.
Of course, it would have been fine if money market was like 15% or 18%. That's why it was very popular when treasury bills was 15, 18%.
Yes.
But I would not recommend money market at 5% per annum for a long period of time.
Yes.
Because the longer you stay in it, the more you lose purchasing power.
Yes. Okay, so just one more question. I'll just take two in one to round this session up. It says, do we have ETFs or index funds? Yes, we do, but I don't know if you want to speak to that now or later.
Yes, we do.
The next question is, what is the NSE ASI? What's the Nigerian Stock Exchange All Share Index? So that's an example of an index.
All Share Index, NSE is Nigerian Stock Exchange, ASI is All Share Index, and the All Share Index is just the average index. It's actually a weighted average index. So once they tell you that the ASI is going up or coming down, it means that share prices on average are either going up or coming down. For example, last Thursday, the stock index of the Nigerian Stock Exchange went up by 1.47%. So it always goes up and comes down. But since this oil crisis, it's really been tanking. It's been going down.
Yeah, so basically it measures the performance of all the shares listed on the stock market. So, but
exactly.
do we have sub-index funds so that NSE? I know there's NSE 30.
Yes, you have sub-indices.
Yeah.
For example, you can say what happened to NSE banking, what happened to NSE industrial goods, what happened to NSE pension, and so on and so forth.
I think we can go on now, and then we'll take the next session.
I think we should.
Yeah.
We'll try and talk next. We're now going to talk about stock valuation. Now, the true value of any financial investment is the present value of the future cash flows that will be derived from the financial investment. In other words, if I'm making an investment today, the true value of that investment, financial investment that I'm making, is the money I'm going to make from that investment in future. But I have to look at the present value. Present value simply recognizes the fact that the purchasing power of money over time changes. For example, if I invest 100,000 today and you give me back 110,000 in I'm talking Naira, 100,000 Naira today, and you give me 100,000 Naira back in 5 years. Yes, that's a gain of 10,000, but by the time you adjust it for inflation, it's probably a massive loss. Because in a 5-year period, inflation would have been more than 10% if you are talking Naira. If you are talking dollars, maybe not. So the value of any financial investment really is the present value of the future cash flows. Now, that very first Excel sheet that I used to illustrate or to model investment returns works on the basis of this principle. When I was talking about purchasing a share today, getting dividends and whatever. Like I said, when it comes to long-term investing, one of the things you need to be careful about is that you are getting returns that exceed inflation. Okay? The price of a stock is the amount of price for which the stock is being sold on the exchange. So if you open the newspapers or if you go online, you'll find the prices of various stocks. Now, the true value of any investment is the present value of the estimated future cash flows from the stock investments. You see, unfortunately, human beings don't know the future for certain. It's only God that does that. So that is why when we're talking about present value of future cash flows, we say estimated future cash flows. Estimated, because it's simply an estimate, because it is futuristic. It's only estimated. And that's why we want to be careful to ensure that we're investing in companies that are well governed, well managed. Oh, by the way, somebody posted a question or a comment. I said that one of the parameters he or she will be looking for in a well governed company is that it will not be a one-man company. I agree with the person that the risk of corporate governance overrides a one-man company is higher. In other words, if a company that's supposed to be a public company is a one-man company, it may be, I mean, it's not an automatic thing, but it may be easier because if one person controls the company, then it's easier for the one person to override controls. I just thought I should put that out there from one of the comments. So really it's about what the company is able to deliver in future. Because if you think about it, whatever company I'm investing in today, yes, it's nice to see track record, but what is going to affect me, my investment returns, is not just the track, it's not even the track record at all. It is the future performance of that company. It is the future performance of the company by way of profit, by way of dividend. Now, there are some, what do you call it, formula. Again, this is a standard valuation formula that the value of a stock today is equal to the expected dividend next year divided by the required rate of return. Required rate of return is your own desired rate of return minus what you deem to be the company's growth rate. So as an illustration, let's just say for the sake of illustration, Nestle. Remember I mentioned earlier on paying dividend of 70 naira. So let's say the expected dividend next year, this last year was 70 naira. Let's say next year is 80 naira, let's just say. Then let's say the rate of return that we require is 20% per annum, right? So you then divide, the figure at the bottom will be, the required rate of return will be 0.2. Now let us say Nestle, again, is able to grow its dividend at the rate of inflation. Inflation is 12% per annum. So that means that at the bottom you have 80 divided by 0.2 minus 0.112 because 12% per annum is 0.12. So that actually comes to 80 divided by 0.1, 0.08. Anyway, when you work out the mathematics, you get 1,000 naira as the value. Now, this is just a rough illustration, but this formula is a standard formula. It's not just like most of us learned Pythagoras theorem. It's a standard thing. It's not something that was derived by me. So you can use this to do a quick valuation. But except you are except you're a finance person, I would suggest that you always seek the advice of an investment advisor. This first formula that you have seen, that you can also turn it around, and it may be easier. This turning around may actually be easier for the average person. The total return that you can expect from any stock is equal to the dividend yield plus the expected growth rate. Now, what that means in simple terms is this. Let us say, for the sake of illustration, again, I can use that Nestle again as an example, that let's say the dividend yield, by the way, is dividend divided by share price. So assuming that the share price of a company, okay, let me just use a hypothetical company. Let's say the share price of a company is 100 naira. And let's say that the dividend is 14 naira. If the share price is 100 and dividend is 14 naira, it means that the dividend yield is 14%. Share price is 100 naira, dividend is 14. The dividend yield, because dividend yield is dividend divided by price, that's 14%. Now, if that company is growing its dividend at the rate of 10% per annum, that means that the total return from that investment over the long term will be 14% plus 10%, 24%. Now, but this assumption is that the company will be able to pay that 14 naira and be able to grow it at 10% per annum. So once that is done, you'll then discover that the investor will actually actualize that return of 24%. per annum. I'll also pause here and take a few questions. If there are questions at this point, I'll take questions.
Are there any questions? I don't see any questions in the chat box right now. But I think I just wanted to ask that when you calculated the value today for Nestle and it came to 1,000 naira, does that mean that that's the value, that's the real value of the Nestle stock today? Because I know that right now, Nestle is trading at about, I think as of yesterday, it closed at 830 naira. In the course of the past 2 weeks, it even went as low as 765. So based on the calculation of that dividend, that means the real value for Nestle is actually 1,000.
Based on that valuation model, there are different valuation models.
Based on this valuation model, okay.
Based on this valuation model.
So basically, if I'm buying Nestle at anything less than 1,000, I'm getting good value.
Roughly, so to speak.
Okay.
Again, based on.
Okay, so someone says, how do we predict growth rate? That's Jayola. Sorry, Jayola, not someone.
It's actually a function of several factors. Because at times, a company that has, one of the things I mentioned earlier is track record, but track record is not the only thing. If you take a company like Nigerian Breweries, up until about 5 years ago, their track record was positive. But subsequent to, in the last 5 years, their track record has been negative. I'm talking about growth rate now. And that's because a few major things happened in their industry. In the brewing industry, we had the entry into the market. Prior to maybe about 6 or 7 years ago, there were only two major players. There were several, but only two major players, Guinness and Nigerian Breweries. Well, about 5 or 6 or so years ago, we then had the entry of SAB Miller. Globally, SAB Miller is a very, very, very big company that can and actually did give both Nigerian Breweries and Guinness a run for their money. So the industry became a lot more competitive and they took market share away from both Guinness and Nigerian Breweries. In addition to that, the federal government also, I think about 2 years ago, introduced excise duty. Excise duty is just extra tax that you pay on your manufactured products. And then coupled with that was also the challenges that the Nigerian economy itself had. So I'm saying that to say this, growth rate is not necessarily a straight line. There are other economic and competitive factors that can actually bring growth rate down. But for most established companies, you'll probably discover that their growth rate is positive. But again, that's why we call it it's not something that it's not an exact science, it's an estimate. That's why you need to look at a lot of those parameters.
Yeah, so from what I hear you saying is the fact that the company has been successful for the past, say, 20, 30 years doesn't mean that they'll continue to be, especially if there are some economic indicators that we've not seen before.
Such as, another example, 20 years ago, if we had been having this seminar, would have said that First Bank and Union Bank were two leading banks within the Nigerian economy. Yeah. You know where they are today.
The banks that started 20 years ago are stronger than them, right?
It's not a static thing. Exactly. There are some banks that were started, well, not quite 20 years ago, let's say about 30 years. Please go ahead.
No, I just want to say that the banks that started about that time, that they were the strongest banks, are now kind of stronger than them.
Absolutely.
In terms of profitability, that's really interesting.
So what I'm also saying that industries are dynamic, they are never static.
Very true. So, but you know, that it makes it very tricky because, for instance, our parents will have bought First Bank and Union Bank and all those shares. So are you saying that it's wise to get out of those stocks now? Because we don't really see any growth unless they are like changed and turned around. Do you think that it's wise to hold on to those stocks?
There are some of them that, okay, let me share my screen again. Are you seeing my screen? No? Are you seeing my screen?
I'm seeing the slides.
Oh, you are seeing the slides. Okay, so let me just go back to, you can see this, right?
Yes, complete. I'm seeing your slides, yes.
Okay. Now, the point I want to make here is that there are all of these parameters. You can use these parameters. Okay, let me just use that Nigerian Breweries. As far as I'm concerned, I believe Nigerian Breweries is a well-governed company, is a well-managed company, is a company that has good performance track record, right?
Yes.
What has happened, or what happened? Okay, let me backtrack a bit. About 2 or 3 years ago, Nigerian Breweries was traded as high as 200 naira. And I said to anybody that cared to listen to me then, that I wasn't saying that Nigerian Breweries was a bad company, right? We're paying 200 naira per share for Nigerian Breweries based on what my own understanding of value for money. I was just throwing money away.
Mm.
Today, Nigerian Breweries is trading for 20-something naira.
Wow.
And at this price, well, I'm not trying to make an investment recommendation now. Please, don't get me wrong. At this price now, somebody getting into Nigerian breweries can probably make money. Again, I'm not making an investment recommendation, but the point I'm trying to make is that there was a time that out of these 4 parameters here, 3 checked, but 1 did not check.
Yeah.
But when prices then move over time, you can find the other one checking.
Mm.
So I'm saying that to say that whilst First Bank and Union Bank were leaders, and there were times that they had their problems, it does not automatically mean that forever those companies cannot be turned around.
Mm. Okay,
but
so
at any point in time, ask yourself about these parameters. Again, if I may just jump ahead a bit or say something that is related, you see, when you invest in shares or when you invest in anything really, there's something that is called portfolio management. Now, portfolio management is really about looking at your stock of investments at any point in time and asking yourselves that the reason or the reasons why I made this investment in the first place, are they still valid? Or do I need to switch this investment from X to Y or from A to B? That portfolio management is extremely important. So somebody that was doing proper portfolio management, even though the person might have invested in First Bank and Union Bank 20 years ago, the person that is doing proper portfolio management at some point would have seen that, look, I need to switch my portfolio. Okay. So
this is a very important point, really, because I know one of the things I read recently was how, on the basis of the fact now that Nigerian breweries was trading at 200 a few years ago, and somebody's seeing it as 20s. Some people might actually buy thinking that it might rise up to that 200 again, but the truth is it might never get to that point again, or it might take a lot longer than. So I think I just wanted to bring out that point that sometimes the fact that the company traded at a high price some years ago does not mean that company is still dynamic enough in that industry to trade at, and that does not even mean that at that 200 it was good value.
True.
Yeah. So I'll just take the next question. Ola says, what's the discount rate to be used? I'm not sure what this question applies to, Ola.
The discount rate to be used is your required rate of return. In other words, the rate of return you desire. For example, we have said that inflation rate is 12%. Somebody can say that, look, if I want to invest in stocks, I need at least maybe 6%, 8%, whatever percent above inflation.
Okay. So based on that, you decide if the value of the company works for you.
Yes.
So I think it's also in line. Let me just go straight down to a question that someone asked and says, can you explain the valuation, how I can apply valuation to my decisions on what stocks to buy? So I guess it ties to the fact that, look, you have to decide what rate of return you want to earn. Exactly. And based on that, look at the previous dividend price. Can you just go back to that slide? It's Agusto. I think the formula with the valuation. Where the formula for valuation, yes.
Is it this one?
Yes. So
let me also provide a bit of
guidance
to me. Okay. Usually required rate of return I've been talking about inflation, but there's also something that is called the risk-free rate of return. Now, there are three important parameters in determining required rate of return. One is inflation. Never knowingly accept any rate of return that is lower than inflation. Emphasis on knowingly accept, right? Now, the other one is what we call the risk-free rate of return. Now, risk-free rate of return usually should be higher than inflation and should reflect what the rate of return you can get when you invest in long-term government bonds. So under normal circumstances, if inflation is running at 12, you'll probably discover that long-term government bonds will yield you about 13, 14, or 15%, right? So if you are to invest in that federal government bond, I'm talking about federal government Naira bond, you will still get a return that is not subject to risk and is higher than inflation, right? Now, when you are not investing in any other thing, be it property, be it shares, be it crowdfunding, whatever it may be that you're investing in, one of the things you say to yourself is that if I can invest and get 14% risk-free, why should I go and do stocks or property or crowdfunding if I don't have a reasonable assurance that I will make more than 14? Because there's a principle in finance that says that the higher the risk, the higher the return should be. It does not make any sense for me to take a higher risk on the expectation of a lower return. And this is precisely why when Treasury bills was going for 18%, 19%, 20%, a lot of people were just said to themselves, instead of going to take risk in the stock market or any other market, why don't I just pack my funds into whether a money market fund or Treasury bills and earn my cool 18, 19, 20 or whatever it was on a total risk-free basis? So you should also think, yes, go ahead.
No, please go ahead then I'll just ask you what I want to ask you.
So it's important for you to, when you're thinking of your required rate of return, you'll be doing yourself a lot, because any other thing you invest in that is not FGM bond or Treasury bill has a measure of risk, no matter how low that risk is. And for an investor, you should get what we call an investment premium for the risk that you are taking.
Yes. So I wanted to bring up the discussion we had about the Dangote bond, because that's one bond that came out recently. So while it is not a federal government bond and it's a corporate bond, it did have a AA risk rating.
Yes.
So are you saying that based on that rating, it is still, because I know that the return was 12% per annum, and you were like, look, at an inflation rate at 12%, you're basically at par, and there's also the risk of currency devaluation as well. So if a corporate bond like that with an AA rating is offered at 12%, you're saying that it is still not at a premium that is worth it to an investor?
Okay, let me just analyze that question, because Tommy and I mean, for the rest of the people in the forum, Tommy and I had probably discussed about Dangote Cement corporate bond at 12%.
Yes.
Now, my take is this. Dangote Cement is an extremely strong company in terms of ability to repay their obligations. I have absolutely no doubts that anybody that invests in Dangote Cement, you will, these bonds that we're talking about, you will get your money back, both principal and interest. However, however, it is a long-term investment. It's a 5-year bond, isn't it?
Yes, yes.
It's a 5-year bond.
Yes, it's a 5-year bond.
The concern I have is to lock in my money for 5 years and get only 12% per annum, because currently inflation is 12% per annum, maybe even slightly higher, right?
Yes.
Although I recognize the fact that today, if I want to put the same money in federal government bonds for 5 years, I will not get more than 11 or maybe 11.5%. So there's a premium over the risk-free rate of return.
Lagos State was 10%.
I'm talking about federal government.
Okay.
Federal government. Again, when you are competing this risk-free, you're not talking about state government, you're talking about federal government. Okay. And the reason for that is that the credit rating of what we call the sub-national, which are the state governments and local governments, is different from the federal government. The federal government has the best credit rating. So that's my concern with, I have absolutely no problems with the company, but is the locking in the money for 5 years. Now, another prominent company that recently issued bonds is Flour Mills. Flour Mills recently issued 3-year bonds at 10% and 5-year bonds at 11.1%. Again, I have no doubts that Flour Mills will not default. You'll get your money back. It's just that the rate of return for a long-term investment, for me, is not sufficiently exciting. And I'm operating from the viewpoint of the fact that, look, this is an environment where inflation is already north of 12%, and in all indications, given all of the economic challenges, in the next 3 years, inflation is likely to be higher. I would definitely not be investing at 10% per annum, knowing that at the end of 3 years, I'll get a negative return.
Okay. So someone says, where can I get information on the NSC pension, NSC 30?
Once you go to the Nigerian Stock Exchange website, you'll see it there.
Okay. So I guess we'll check for you, Remy, and get back to you. Yeah. So Yinka says,
yes.
I just move on to the next question. We'll do the check and get back to her on that. So Yinka says, okay, should the all share index be used as a benchmark price? I'm not sure.
It's actually is a benchmark, it's an average. It's just an average of everybody, the good, the bad, and the ugly.
Okay. So should you use that as a benchmark for what you invest in? I mean, I don't know if I got your question right.
I mean, it is a benchmark for market performance. That's what it is.
Yeah. So should that also determine the performance of each stock? I mean, if the average, average index.
All share index. Well, the truth is that some companies will do better, some companies will do worse. It's just an average. It's like saying that we took a test. The average in the class was 65%. Some people will be better than 65, some people will be worse than 65.
Okay. So, Ola says, what's the time horizon for discounting?
Whatever time frame your investment is, your proposed investment is.
What should be the time frame for investing in the stock market, really? I think 5 to 10.
One of the advice I normally give to people is that they should not use the stock market for short-term investment. And the reason is this. You see, at any point in time, stock prices, they reflect supply and demand. Supply and demand in the short term is typically based on short-term. For example, supply and demand in the Nigerian Stock Exchange today is based on all the wahala that there is in the world, right?
Yeah.
But in the long term, supply and demand will reflect performance of the company. So if you have really invested in a good company whose performance is on the uptick, you will find out that almost invariably share prices will go up. And I believe that question, actually, let me flip that question. Let me flip to the other material that I think is less technical than this and also speaks to what is going on currently in the stock market. Because I believe that will also add color to this presentation that I have made. So if you permit me, I would want to share something else.
Okay. Should we answer the questions for this session first before we go to that?
Don't worry, let's go to that. We will one way or the other, we'll answer all the questions.
Okay.
Just a minute. This is another webinar I did recently, opportunities in the midst of the current stock market meltdown. Let me just go through some things very, very quickly. That would, like I said, they are less technical and they will add color to the things that were discussed previously. Now, under normal circumstances, quoted stock prices ought to reflect the long-term value in each company. That's a normal thing. So when you see a stock being quoted at a particular price, the expectation, the normal thing is that that price ought to reflect the long-term value in that company. And long-term value, if you can put it in very simple terms, is how much money they're going to make and how much money they're going to give me, right? On a sustainable basis. Now, however, during periods of economic and or financial crisis, you almost invariably, anywhere, whether you're trading on NASDAQ in US or you're trading on FTSE in London or CAC in Germany or wherever you are trading, stock price generally crash in response to prevailing gloom and doom with little regard for the future of the companies. Now, for example, there are companies like, let's say Cadbury, for example. The company has been in existence for 50 years, right? But during periods of crisis, you will see the stock prices crash to such a level that you'll actually think that the company has gone bust or is about to go bust. But yet, we see that a lot of these companies, they've gone through thick and thin, so to speak, in terms of economic performance. Now, what then tends to happen is that such price crashes therefore create opportunities to invest in. You can see that we have highlighted sound companies and cheap prices. So it's not every day that you will get an opportunity to invest in sound companies at cheap prices. It's not something that happens every day. But typically during periods of financial crisis, whether it was the global financial crisis of 2008 and 2009, whether it was the Nigerian recession of 2016, or the current or impending Nigerian whatever, these are the kind of opportunities that are created. Now, the beauty about this is that once you purchase the stock or the investment, you have locked in the future returns or the future benefits from that investment, and you can actually hold it for as long as you desire. If you get an opportunity to buy treasury bills at 18% today, there is no guarantee that next year it will still be 18%. Because so once it matures, there's a risk that you are going to reinvest at a lower rate. The risk that has crystallized for most of Nigerian investors in treasury bills now. However, for the kind of stock investments that we're talking about, if you're able to lay your hands on them at a very cheap price, you can actually lock in a very good future return almost permanently. And I'll speak to that. I'll illustrate this a bit later. Now, so what's creating the opportunity? What's creating the opportunity at this point in time is that there is global and Nigerian economic challenges. Now, we're all aware of what is going on with COVID-19, the global pandemic, mass loss of human lives, significantly reduced economic activities almost everywhere, and then the crash in crude oil prices. Now, the crash in crude oil prices in particular has affected the Nigerian economy, or is affecting the Nigerian economy in this wise. Crude oil prices have crashed, it's depleted our foreign reserves. So a lot of these things, I'm sure that we all know, the negative impact of the crude oil prices on the domestic, whatever. Even the finance minister, this is what she said recently. This is recently as in, I believe, March 31. She said that prior to the outbreak, which led to in other words, prior to COVID-19, which led to the decline in crude oil prices, the Nigerian economy was already fragile, vulnerable, and deteriorating. That's the finance minister. Now, by way of charts, this is what has happened. Crude oil prices has halved in price, and that has significant and dire implications for the Nigerian economy. That's why the economic team had to go back to the drawing table concerning the 2020 budget, because a huge portion of the budgeted revenue is oil and oil related. Now, this is what has happened to the Nigerian external reserves. January 2019 was about $42 billion. As of now, is about 34 billion, and it's still going down. Exchange rates have spiked. It's gone up from about 360 to the official interbank exchange rate has gone as high as 390, 385. But most of us know that in the Bureau de Change market, it's already exceeded 400. So these are the kind of economic challenges that this has brought on Nigeria, well, first of all, on the global scene as well as on Nigeria. And that's why when you read news internationally, you see stock prices everywhere has been on the downturn, and the Nigerian market has not been an exception. But you see, in the midst of all of this, there are usually opportunities in the midst of all of this. Usually there are opportunities. You saw this one earlier on, this slide earlier on. So what I just want to do is, this is what has happened to stock prices. This is what happened to Nestle, GT Bank, Zenith, Dangote, Siemens. This is around February this year when oil prices began to collapse. See what has happened to all the stock prices. Everything has gone south. Like I said, the good, the bad, and the ugly. But the question is, in the midst of all of this, are there opportunities? Now, in order to answer that question, I would like to present some things to you about opportunities in the midst of some of the crashes that we have had before. Because during any period of economic crisis, the way people react is as if the world is about to come to an end. But the thing is that we've had financial crisis, economic crisis in the past, and the world really never came to an end. Now, I'm going to use examples from the past, using different time frames. What happened to Nestle during the crash of 2008? What happened to Zenith Bank during the crash of 2016? What happened to Dangote Sugar during the crash of 2016? And what happened to GT Bank during the 2005 public offer? All of these are from different time frames. Nestle Foods is about 12 years ago. Zenith and Dangote are about 4 years ago. GT Bank is a little longer than that. Okay, let's look at what happened. Now, as at 31st December, excuse me, please. As at 31st December 2008, you could buy one share of Nestle for 191 naira 44 kobo. So in this example, I'm going to assume that somebody actually invested in Nestle at 191 naira 44 kobo. Now, just so to put things in perspective, just to show that I did not just select a very low point. During the year 2009, which is a few months after 31st December 2008, Nestle actually went as low as 100 naira. So the 191 was not the best price you could buy. It was actually like 2 times the best price you could buy. So let's fast forward to 2020 and ask ourselves what has happened since then, right? The second point on my bullets, whatever, is that between then and now, Nestle has issued bonus shares, that is 1 for 5, meaning 20%. What that simply means is that for every 1 share that was purchased in 2008, the investor now owns 1.2 shares. Now, point number 4, for the year 2019 accounting year, which was last year, the total dividend that Nestle paid on 1.2 shares, that's the equivalent of a single share in 2008, was actually 75 naira 60 kobo, which is 39% of the purchase price. In other words, last year alone, if you purchased at that price in 2008, you got 39% of your investment. If you were extremely lucky and you purchased at 100 naira, your return was probably about 75% in 1 year alone. But we're not going to rely on luck. Now, in the last 5 years, the dividend you collected is already like 113% of your purchase price. And the total dividend you've collected since 2008 is about 2 times your entire investment. Now, as of 7th of April, 1.2 shares of Nestle was 917 naira. Now, just to show you that the share price has significantly crashed, just 3 short months back, 31st December 2019, the same 1.2 shares was worth 1,763. Now, let me just put things in perspective. Let me assume that you're a money bag and you actually had 191 million in 2008, and you were bold enough to invest in the stock market. at that time because everything had crashed at that time. What it means is that your 191 million that you invested, first of all, today is actually worth about your 191 million naira that you invested today is actually worth about R1 billion. And the second thing is that the 191 million that you invested, you have actually collected about 400 million in dividends. So, but the only reason why these figures are this rosy is because that 191 at that time, 191 naira 44 kobo, represents a crash. Just like a lot of stock prices today, they actually represent crashes. But it's an irony that it is when share prices are crashing, when they represent better value for money, that people are selling rather than buying. Like I said earlier, Warren Buffett actually does the opposite. It is when share prices tank, that's when he goes into the market to buy, because he knows that those companies are being sold at a bargain at that particular point in time.
Wow.
I'd like to pause at this point and take questions. Funmi, over to you.
So, Irene, I'm looking at this right now, like, wow, as of December 31st, Nestle was 1,763. And right now, I think 2 weeks ago, I bought it at 765. Now, I guess I've earned amazing value already.
You have actually earned amazing value. You know, it was based on, Funmi and I actually discussed that one of the things I recommended for her, this is a private recommendation between Funmi and myself. I'm sure she's smiling now. But the point is this. A lot of people feel that if you buy something for 765 and it goes to 1,000, right? You are happy. But you see, the point I'm trying to make, the inherent value is actually more than that 1,000. The inherent value are the future stream of dividends that you are going to collect.
Yes.
One thing is that share price will always go up or down. But I don't know, are there any other questions about these calculations?
Yes.
I think 1.2 shares.
No, so we'll just take the questions that were asked before, because I think I want you to show 1 or 2 examples in other sectors. So people can see that. Okay,
let me show other examples, because we actually have 4 examples here. So This is Nestle.
Okay.
So some of you might think, 2008, that's 12 years ago. Who wants to invest for 12 years? Okay, let's look at Zenith Bank. 2016 was it was actually 2016 Q1. Again, that was the time that Naira was going through devaluation. That was the time that Nigeria was entering economic recession for like the first time in 20 years. That was the time that oil price also crashed to a record low at that point in time. So everybody was saying that, Nigerian economy is gone to the dogs. So of course, what happened was that share prices in every sector, the good, the bad, the ugly, went down. And Zenith Bank actually traded for as low as 9 naira 44 kobo during that quarter. But again, I'm not going to take the lowest point. I took sort of average. So if somebody got in at 11 naira, guess what? Between that 2016 and now, you have collected 10 naira 49 kobo as dividend. Collected, not will collect. Right? So 95% of your purchase price is already collected, is in the bank. So to speak, you have recovered your entire investment. And then as of 7th of April, your investment was still worth 12 naira 94 kobo. For those of you that follow the stock market, you will know that as of last Thursday, this 12.95 was actually 14 naira. Again, as of 31st December, it was 18 naira 60 kobo. So it's actually crashed. Now, I'd like to contrast it to somebody that bought. I'd like to contrast this to somebody that bought property for 11 million naira in 2016. The person will probably have collected cumulatively rent of about 2 million or 2.5 million. And I doubt whether the value of 11 million property 4 years ago will be more than 14 million now. Okay, so this is a Zenith over a 4-year period. We'll take another 4-year period example. This is Dangote Sugar, not Dangote Cement. Again, it crashed to as low as 5 naira 17 kobo, but again, we'll take a quarter average of about 5 naira 97 kobo. So we're not using the best price. Of course, there will be some people, lucky people, who bought at 5 naira 17 kobo. Now again, for the last 4 years, excluding 2000, the current year, because they're about to release their results and pay dividend. So you've collected 68% of your purchase price as dividend. By the time this one comes out, which will come out, I believe, this month of April, you probably will add another 1 naira to this 356. But let's even leave it at that. Again, it was 8 naira 90 kobo. So you purchased at 5 naira 97 kobo. You collected 68% as dividend, and you still have 8 naira 90 kobo. Again, because for some stock market, like I told you, it always goes up and down. In the last 2 days, the market has actually rallied. So this share price of 7th April, by 9th April, it was actually 10 naira 70 kobo. So between just in 2 days, the market added, I'm talking about Dangote Sugar, added about 20% in 2 days. So theoretically, somebody that bought on April 7 could have sold on April 9. But I must caution on that. Stock market always, just as it went up 20%, it can also come down 20%. Don't get carried away by that. Those are what we call short-term volatility. But if you're able to purchase at a very good price and you're in it for the medium to long term, these are the kind of returns that are possible. So we've looked at Nestle Foods over a 12-year time frame. We've looked at Zenith Bank over a 4-year time frame. We've looked at Dangote Sugar over a 4-year time frame. Let's also look at GT Bank. Most of us on this forum will remember consolidation of 2005 when a lot of banks did public offer. I recollect that GT Bank's public offer was sold at a price of 10 naira 60 kobo. So you could buy one share of GT Bank at that time for 10 naira 60 kobo. Okay. Now, but between 2005 and now, because it's a long period of time, GT Bank has paid a number of bonus shares. So somebody that owned one share then has collected 2.5 shares extra at absolutely no cost. So on that single investment of 10 naira 60 kobo of one share, the person now owns 3.5 shares. Now, in the year 2019 alone, that's the last year, for that one share that was purchased at 10 naira 60 kobo, the investor actually collected 8 naira 82 kobo as dividend. So the person invested 10 naira 60 kobo, and in 1 year alone collected 83% of the investment as dividend, right? Now, if you do the math and look at it cumulatively since 2005 up till now, the person has collected about 3 times the investment as dividend. Now, as at 7th of April, the share price per share of GT Bank was 18 naira, down from 29.7 as at 31st December. At that 18 naira per share, somebody that bought one share at 10 naira 60 kobo and now has 3.5 shares is actually amounts to 63 naira, in spite of having collected 3 times the investment back. Now let me try and put this into perspective. Assuming that somebody, again, you purchased 1 million units at 10 naira 60 kobo, so you actually invested 10.6 million. So what it means is that over the years you've collected, for that investment of 10.6 million, you've collected about 33 or 32 million as your dividend. And in addition to collecting 32 million as dividend, your investment is now worth 63 million. And just as near back as December, that same investment was actually worth 103 million. Now, the only reason why these returns that you see here, I'll tell you the reasons why they are so positive, right? One major reason is that the entry price or the purchase price was when there was all gloom and doom in the market, and the last thing on anybody's mind was to buy shares. Therefore, the prices were very low. And the price I've also used, right, except for the public offer that's whatever, I didn't use the list price. So it means that these returns were actually achievable. So that's one. Now, the other thing is that you are buying into companies that survived the economic and financial crisis. In other words, the crisis did not consume the companies, right? The companies were still able to function post-crisis. They were still able to make money. They were still able to pay dividend. Interestingly, a lot of these companies, even during the crisis period, a lot of these companies that I use as illustration here, even during the crisis period, they actually continue to make profits and they continue to pay dividend. And ironically, their share prices were down. Okay, so I'd like to pause now and take questions and comments because I know from experience that here, I tend to get a lot of questions and a lot of comments. Now, it doesn't mean that during periods of crisis, just go out and buy anything. You have to ensure you're buying quality. Because like I think I said earlier on, when prices are going up, everybody will go up, the good, the bad, the ugly. And when prices are coming down, the good, the bad, the ugly will also come down. So the opportunity really exists when you're able to buy or invest in sound companies at fundamental cheap prices. And again, I'm not saying that these are the only four. I mean, we can't use every single company as an illustration, but these four companies illustrate the point. So I'll pause and take questions.
Okay, so I'll just take some questions from the previous session. So Tochi says, is total return the same as the annualized rate of return in your previous model? I think she's referring to the Excel model.
No, it's not the same thing. That annualized rate of return breaks it down into annual rate of return. By the time you analyze these returns, they are far ahead of any of the things that we have seen earlier on. Because you have a situation where you make an investment, you collect your investment back 3 times, and then you still have value that is times 6 of what you invested.
Yes.
Next question.
Okay, so just go through now. Let me just see if there's anyone who answered. Where can one get information on market share and market leadership?
You just have to go on the internet now.
Well, I guess you can just check who's
on the internet. There's
industry.
almost nothing you cannot get. Ask Alexia.
Or Siri. No problem. We will note that down and see if we can get that information for the Green Club as well. So Theresa says that should I consider the all share index before I buy shares? I think she came in at the point when we're talking about the all share index, but I don't think that's what she considered.
No, like we said, the all share index is just an average of everything.
Yeah. Okay, so let me see if there are any more questions. Says, do you think the share prices will dip further, basically as the market bottomed out yet? I mean, there's a lot happening. We saw the market rise Thursday, Friday. A lot of stocks went up because of the OPEC decision to cut back production. But do you think that is that sustainable? Because there's still the pandemic spread, and we don't know if China is going to continue to come back into demand, because the major shock was the demand shock from China, and then the supply shock as well, which had to be cut short. So I guess people are still asking that, as the market bottomed out yet? But I know that. Anyway, let me let you answer that.
Okay, I will answer with a caveat, and it will be with a caveat that you cannot, nobody will disagree with.
Okay.
The caveat is that I am not God, so I do not know the future perfectly, right?
Yeah.
However, I can give you my own personal opinion, and I'll tell you the indicators I'm looking at. My personal, you see emphasis on personal. My personal opinion is that the market has not bottomed out. Now, that's because I also foresee there's still trouble ahead in terms of exchange rates, economy, oil reserve, whatever. For example, if I take the OPEC agreement, the OPEC agreement so far is to take away 10 million barrels per day of supply. The problem in the market today is a 30 million barrel per day problem. So after the next few days now, the market is going to see that, look, yes, it's nice to take 10 million away, but 10 million does not cut it. Remember also the words of the Nigerian finance minister. Let me just quickly go back there. The words of the Nigerian finance minister. She said that before COVID-19 arrived on our shores, I'm paraphrasing now, that led to declining, before Russia and Saudi Arabia began to fight at all, the Nigerian economy was already fragile, vulnerable, and deteriorating. It's a bit like this COVID-19. They say that it tends to have the most negative impact on those that have underlying medical conditions already. So the Nigerian economy before this crisis had underlying economic conditions. So that is what my own view, personal, emphasis on personal, is predicated on. I still think stock prices will come down. However, having said that, I believe that current prices represent, again, we're talking about sound companies. I believe that current prices represent very, very good value for money.
So I guess another thing is maybe this question.
Now, also, let me also say that it's also, and that's why at times financial advisors will advise people to buy in bits. In other words, let's say you want to put in 100%. Don't throw in 100% at the same time. Buy in bits. And when you buy in bits, what would invariably happen is that some you buy at high price, some will buy at low prices. But if you put all the money in one bulk, you may buy at a high price, you may buy at a low price. So it's a bit more risky.
Yes.
But one thing I can say, again, my opinion is that current prices, they actually represent very, very good value for money. But I don't know whether it's going to be higher. I don't know whether it's going to be lower for a fact.
So I guess this is also another principle for long-term investing, that it's not really about timing the market. It's really about focusing on getting great companies at good value. So I think that's one key principle that you mentioned.
But it's just that it can be painful. It can be painful. Let's say you wanted to buy Dangote sugar at 8.90, and you discover that you have to buy at 11. You say, why didn't I buy? On the other hand, if you had bought at 11 and you now see it slide to 9, I say I should have waited. But the truth is that nobody can really predict the future. But you can look at economic indicators just like I did now and say that, oh, this is my take. And I encourage everybody to do. And you see, looking at the same indicators, we can have two different economic outlook.
Yes. So that's another thing I wanted to also reiterate from what you said is a lot of people, post-COVID is very unclear to a lot of countries. But even in Nigeria, we know that, like you mentioned, there's still a lot that we need to battle with because we already cut back our budget, for instance, and the country is still looking to borrow, but they couldn't borrow. So there's so many things that are still unclear at this point. So it's not even sure where the economy is going. And we know due to the lockdown as well.
See, just like things were unclear in 2008, 2009, just like they were unclear in 2006. In 2006, they were, oh, this is the first time in 20 years that the economy was going into recession. Inflation is this. You see, those things will happen. And that's why stock price, like I said, they generally, during periods of financial and economic crisis, they reflect the doom and gloom, right? But let me tell you what's going to happen post-COVID. Post-COVID is not the first pandemic that is going to come. It will come to pass. Economies across the world will return to normal. People would be doing social, what's the opposite of social distancing? People will come together. It might take some time, but what I'm trying to say is that things will return to normal at some point. I don't know how long it's going to take. Again, I'm not good. I can't predict the future. But you see, these things, they come in cycles. I don't think, for example, nobody is flying now. I don't think that all the airports and all the countries will be on lockdown for the next 3 years. Have you?
Yeah, it's not sustainable. There have to be measures put in place, right? So that's, and which I think this is also a very important point, which is you have to think about the stock market as a long-term investment. So you have to put funds that you can afford to give there long-term.
Okay, so, just to buttress what Funmi just said now, let me go back to some of the things that I have shown. For example, let me use this. Remember I said that somebody purchased at 191.
Yeah.
Can you imagine that person by the time in about 3 months, what you bought for 191 went down to 100 here? The person's heart to be in their mouths, wouldn't it?
Yes.
don't forget that this was during the period of global financial crisis. It was not just a Nigerian thing. So some people would actually have said to their brokers, please, I want to cut my losses. Just sell and give me back my money. At least I can still get 100 out of the 191. I mean?
Yeah.
So it's not a total loss. Some people will not even wait till 100. Once the thing reaches like 175 or 164, say, please sell the thing and bring me my money. But you can see that somebody who waited it out, you can see the kind of return that they made. That just buttresses the point that stock market is not a straight line thing. Again, if you look at this graph, you can see that even when it's going up, it's not straight line. When it's coming down to, it's not straight line, right? There's always volatility. If you come here too, where you have had very great returns, some of you may not remember this, but during the financial crisis, this 10 naira 60 kobo that you see here went as low as 5 naira.
Wow.
So theoretically, some people could have purchased in 2008, 2009 and paid 5 naira for this.
Wow.
So you see, that is the investment principle of Warren Buffett, but it's counterintuitive because you could have bought at 10. The same person that bought at 10 here, by the time the thing got to 7 naira, could have just called a broker. I told you to sell this thing. Why are you waiting? Where's my money? You understand me?
Yes.
Meanwhile, just riding the storm, you can make this almost unbelievable kind of return. So that also says that the long-term mindset is also important, and that it's almost never the case that you will not have short-term dips. And that's why you need to be convinced, and that's why I said earlier on that people who are investing, they're investing in companies. So the question you're asking yourself is that in spite of what is going on in the market, what is happening in the company called Agusto Sugar as an example? What is happening in the company called Flour Mills as an example? What is happening there? Yes, I see this thing happening in the stock market. I see the economy on lockdown. But do you know the irony? The irony is that this lockdown, there are some companies that will actually benefit from them. Meanwhile, their share prices will go down because prices are going down generally. This impending devaluation, again, some companies will actually benefit from devaluation, but everything is just going down. So at times, the irony is that the factors that are dragging down the market as a whole, there are a few, admittedly minority, that will actually benefit from those events. So for example, we're all saying that, oh, Naira is being devalued, foreign reserve is this, oil price has crashed. Some companies will benefit from devaluation. We're saying that, oh, all the borders are closed, blah, 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 blah. There are some people that by closing the border, you are closing out competition for their products, and they are selling more. So discerning investors, these are some of the questions they ask themselves as well. Say that, yes, I see all the doom and gloom, but are there people, are there companies, are there industries, are there sectors that are set to that will benefit from all of this whatever, or maybe even benefiting already? Now, for example, you see we're in April now. A lot of companies are going to release their Q1 results, right? You'll actually see that from Q1 results of the companies, some companies are actually still doing well. Yes, the economy is going to go through serious challenges, right? But what we're saying is that in the midst of the challenges, some people will still do well. Incidentally, if you go to this example that we gave, now this 12-year period, that you see, okay, let me use this. This 4-year period that you see here, let me tell you what we had during this period. We had the worst recession in Nigeria's recent history. We had the highest amount of inflation. We had the highest amount of devaluation. And yet the company survived and posted these results. Now, if you go to this, we had global financial crisis. We had Nigerian economic recession. We had inflation. We had dollar move from 120 to 360 or 400, depending on where you sit. And yet the company posted these results. So what that does is that it shows you that these companies at least in the past, they've demonstrated that they've been able to go through economic challenges and come out. By the way, this 191 that you see here, this 191 that you see here, can you see it? Is actually in dollar terms, because the exchange rate at that time was 120. In dollar terms, it was $1.60. Now, if you take this 917, if you use the exchange rate of 400, right? This 917 you see here, if you use an exchange rate of 400, it comes to $2.30. If you take this 1763 and use an exchange rate of 360 as it was then, it's actually $4.80. I'll go through that again. This price here is $1.60. This one is $2.30, and it has since moved up since then. And then this is $4.80. So in the midst of inflation, in the midst of devaluation, in the midst of economic recession, in the midst of COVID-19, in the midst of global financial crisis, people were still eating because Nestle was selling food items.
Okay, so EJ says, is it advisable to buy global oil stocks now?
I don't know. I don't know.
Well, I guess looking at the trend in oil prices and all, I don't know. I think it's a very volatile time now. And it really depends on the company's track record.
I don't know.
I think EJ will discuss that maybe on the webinar for foreign stocks more. So, so is it smart to buy Nestle at 800 Naira? I think we've answered that question, Adebayo. Looking at that example that we gave, showing the track record.
Again, I'm answering all these questions with a caveat. I believe that it represents very good value for money at that price, but please, I cannot guarantee that those prices may not still come down. I don't know.
Yeah. So again,
my very good example is this one here. Can you see? Where somebody purchased at 191 and it still went further to 100. So if I had recommended the thing at 191, the person will come to me when it's 100 and say, where's my money?
Which is why you shouldn't just focus on share price, really. You should really focus on the dividend that you earn over a period of time, long term.
Yeah, but the person that bought at 100 Naira will be getting 2 times the return that the person that bought at 191 Naira. That's the problem.
True. So
you can imagine buying at 100. Instead of these 2 times that you see here, it will be 4 times.
True. So I guess you can't time the markets. Just buy in dips, or in how did you put it? Buy little at a time in bits. So that would help. Ika says, what sharing ratio would you advise for investing in top companies? I think she's asking, how should I allocate my investments? Should I put
I'll answer that question generally. I think it's always advisable not to put all your eggs in one basket. So what that means is that you diversify your portfolio. You diversify not only by company, by industry. Just as an illustration, you can say that, oh, I want to invest in food companies because people will always eat, and that would be a valid consideration. You can say I want to invest in telcos because internet, data, voice calls is the future. Nobody can fault that. You can say that I want to do banking because if there are no banks, we are still going to, although opinion may be divided. Some people might say instead of banking, why don't you go for fintech? So opinion might be divided on that. But whether it's banking, whether it's fintech or whatever, some financial architecture. Another person can say, I want to invest in industrial goods. The person could say, for example, that look, by the time this coronavirus virus or COVID or whatever goes away, people are still going to continue to build houses, they're going to continue to build roads. Therefore, I want to invest in industrial goods. Nobody can fault you. Another person can say that, oh, what about insurance? For any economy to grow, there has to be people who are underwriting risk. So you can take different sectors like that. So you can diversify by sector also. But again, one piece of advice I always like to give is that in your diversification efforts, one of the questions you should always ask yourself, who are the strong companies? Who are the industry leaders? Who are the well-managed, well-governed companies within each of these sectors? So that you are putting your money behind people who already have a demonstrated track record and are likely to remain the winners in the industry.
Okay.
So you're not gambling with money.
Absolutely. So, and if you have issues with knowing the market leaders, Green Club's got you covered. So, next question. Tony says, where's that question now? How do we go about purchasing Nestle? You can purchase Nestle through our partner, Coronation Securities, Tony. Just reach out to Lola, she'll put you through on that. Jerry, I will take that question on apps later, but let's just go on to the other questions. Only says, are there other personal stock recommendations you can share?
Yes, there are, but I mean, this is not really about personal stock recommendation. Like I said, talk to your investment advisor.
Yes. So,
unfortunately,
Jerry, I know we share. Who asked that question? Anwuli, we shared recommendations from Coronation Securities in the newsletter this week, so you can check that out, and you can always get their stock recommendations anytime you want from Lola. All right. So EJ says, what is the basis for a stock price? That's because some prices do not make sense, such as Seplat.
The basis for a stock price is balance of supply and demand. The price you see there is the price at which somebody is offering and somebody is buying.
But Mr. Agusto, we know this is something we spoke about in the physical class. Sometimes some companies actually step in to manipulate their share prices, so to speak.
That's possible, but that's illegal.
That is illegal. But we've seen that happen. So
it's a crime, of course.
But we know that. So how do you know that? So I guess the basis now is if you see a company that is at a particular price, it doesn't always spell value all the time. I mean, you give the example of Nigerian breweries. Nigerian breweries, was it on the basis of demand and supply? Or perhaps
everything is based on demand and supply.
But you know, Mr. Agusto, sometimes
you won't see that price. No, you won't see that price if somebody is not buying or somebody is not selling.
What if this is a company buying? Share buyback. What if it's a company buying? What if it's a company telling their staff?
Share buyback is legal, but share manipulation is different.
But we've seen cases where companies tell their staff to buy. They even give them loans to buy, to manipulate their prices. So how?
That's why I said talk to your friends. Don't just rely on what you see in the annual reports. They will tell you what is really going on.
I think this really happened during the bubble that we had. I think it was 2008,
exactly.
2009.
Yes.
A lot of
it
companies.
Happened a lot during 2008.
Yeah, so are we saying that can happen again, or the regulators are really trying to ensure that these illegal activities don't happen again?
No, one thing I can say is that regulation is better now. But you see, even in the best regulated markets in the world, you still have insider abuses.
Yes.
So I think we are going to be kidding ourselves if we just say that, oh, it can never happen again. No.
So I guess,
in fact, if anything, it will happen.
Yes.
The scale and the magnitude might be different. If anything, it will still happen.
True. So I guess, AJ, let's just stick to recommendations from stock advisors and, people that we also share in the Green Club. So Victoria, the list of sound companies, I think one of the things we mentioned were the 40 companies in the NSE pension, which we said they are the mandated shares for. I think that is actually a safe sounding board if you even want to pick what companies are sound, because you would think that if they're recommending them for pension companies, then they must be good stock. So Ola says, with the foreign exchange borrowings affect foreign reserves? I'm assuming you're asking the foreign exchange borrowing by the government.
You see, what has happened now is that our major source of accretion to foreign reserves is oil. The price is down. So that's why the reserves are going down. In fact, you can actually, if you want, you can actually monitor on a daily basis what's happening to Nigerian reserves. Just go to Central Bank website, you'll find it there. It's not a secret.
Okay. Yeah. So once it's dropping, it's a sound of alarm, because if your reserves
is dropping consistently.
Okay.
It can drop and go up, but when it's dropping consistently, and we also know, like, it's public knowledge now, that oil prices, for example, the initial budget was based on $57 per barrel of oil. Today, it's about $31 per barrel. I mean, you don't need to be a financial analyst to know that that is wahala. And then also, if you've been in Nigeria for long enough, you know that we have seen periods of, again, the nearest one back was 2016, 2017, when it went as low as 28. So we all know that in the Nigerian economy, once oil prices go down, it's trouble.
Yes.
And oil prices are not only going down now, even our production quota is also going down.
Yes, so that's like And then there's also the dilemma.
Surely as it goes down, at some point it will come back up. That's why it's called a cycle. You know, when you're riding a cycle, the pedal will go up, come down, go up, come down, go down, up, come down. All prices are cyclical.
Yes. And I think there's also the issue of the government using our foreign reserves to keep the currency stable. So it's kind of like we just have issues everywhere. Do you want to speak?
I mean, let me just go back to these charts. Like I said earlier on, this is finance minister. We had challenges before. It's not our challenge is not limited to the pandemic. It's just accentuated by the pandemic. This is what has happened to oil price. This is what has happened to external reserves. This is what has happened to the exchange rates. All of these are indicators that all is not, it's not business as usual in the economy.
Yes.
They are leading indicators they're leading indicators of further trouble down the line.
Yes. So Tochi says, does this mean that the share price does not affect the performance of the company? It's just for you as a buyer?
No. You see, okay, like I said earlier on, under normal circumstances, quoted share prices will reflect long-term value under normal circumstances. Now, however, when there is trouble economically or financially, when there's a crisis in any country, right? People head for the exit doors when it comes to stocks. People are giving their stockbrokers sell orders. People are going online on their apps and selling, right? That preponderance of sell orders or selling actually then creates more supply than demand, and the prices crash. Now, the point we're making is that people don't necessarily do that, don't necessarily give those selling orders on a purely rational basis. They are not thinking of the long-term value of the company. They're just thinking that there's a financial crisis, Naira is being devalued, foreign reserves is being depleted, please sell and give me my money. In fact, on the Nigerian Stock Exchange, one particular group of investors that have contributed a lot to the price decline are the foreign investors. Because anytime there is particularly a crisis that is global in nature, you'll find out that foreign investors, portfolio investors, they are selling out of emerging markets. They are going into the safety of the US dollar.
Yeah.
So when the storm is then over, they'll then reassess the situation. Fortunately or unfortunately for them, by the time they are reassessing the situation, the investments are cheaper in dollar terms. Because some have actually existed at 360 to 1, right? By the time they are coming back, I don't know what the exchange rate is going to be, plus a cheaper Naira, whatever. So foreign portfolio investors in particular, they don't even think twice. They go into, and that's why also you'll find out that US dollars, during periods of global economic crisis, US dollars will appreciate relative to other currencies. Because even investors move out of pounds, euros, Japanese yen, they move into what they call safe haven. Dollar is considered as a safe haven currency.
Yes.
They usually move into US treasuries.
Yes. Because even the pound devalued.
Even the pound has taken a beating.
Yes. Pound devalued to the Naira. So
that's just what happens. But the point we're trying to make you understand is that in the midst of all of that crisis, and indeed in the midst of any crisis, there are usually opportunities.
Yes.
Because surely as they have left, these foreign investors are still going to come back, and they will now be buying at a higher Naira price.
Yes. But Mr. Agusto, pushing this question further, actually, I think what I want you to make this clear to Tochi is share prices indicates the value of a company, the valuation of the company on the stock market. But
no. Let me correct that.
Okay.
In the short term, share prices will always reflect supply and demand.
Yes.
Sorry, in the short or long term, share price reflects supply and demand. In the short term, they can represent sentiments, just like they represent sentiments currently. But in the long term, they will reflect performance.
Oh, okay. Because what I wanted you to really share is the fact that, look, the company's value, the company has a something value.
Tommy, I want to say something that probably will shock people in this forum.
Okay.
Remember this example. The share that you purchased at 10.60 kobo in 2005. Do you know the amount of earnings per share that this company generated for you last year? This share that you paid 10.60 kobo for, the earnings per share for last year was 24.36 kobo.
What was the dividend per share?
Dividend per share was 8.82 kobo net of all taxes. Let me complete the dividend per share gross of taxes. Gross of taxes, the dividend per share was this 8.82, was 9.8 gross per share.
Wow. So basically, you were paid back almost what you bought the share price at.
Exactly. And that was just last year alone.
Wow.
And what was earned for you as a shareholder, because the difference between the earnings and the dividend is actually retained in the business for future growth of the company. Yes. What was earned for you as a shareholder was actually higher than it was 24 naira. 24 naira is more than twice what you paid for it. And that was what was earned for you in 1 year. So I'm saying that to say this, there's actually a benefit to long-term investing, particularly for younger people, because over time, your returns are compounded. Now, let me mention another thing. This investor that purchased this share at 10 naira, if the person faithfully invested every single dividend, right? Every single dividend, the person, this figure you see here of 63 naira will be about 250 naira. Because it will be about times 4 of this if you faithfully invested every dividend check or credit that you got
back into the company. Yeah.
Back into the company.
Okay. I think later on, Mr. Agusto, maybe you just oblige us by telling us how you have personally earned income from the stock market. But anyway, let me get back to questions.
The only thing I'm going to say publicly, because it's also public information.
No, but wait, Mr. Agusto, let's answer the questions first.
No, don't worry. Two of my children are standing behind me. I have sent 4 children to school. And some of the things I used to send them to school.
And please note that he sends them to school abroad, so he paid school fees in dollars from investments in the stock market. Mr. Agusto, isn't that so?
Partly, not fully, partly.
Okay, partly. All right. So let's move on to the next question. It says, Ola says, you said we should ask our friends in target companies how well the companies are doing. Isn't that insider dealing?
No, it's not insider. No. Okay, sorry. Let me clarify that. Not how well. I'm not asking for market sensitive information. That's why I said, let's say you have a friend who is working in the telecoms industry. They can tell you what is going on in that industry. There's a big difference between general information and market sensitive. Of course, if it's market sensitive information, that is insider trading, that is illegal.
Yes. Yeah, and then, so let me just see if I've not missed out any questions. So Lukman says, is dividend paid quarterly or annually?
Most companies pay dividend annually. Some companies pay twice per year.
Okay. So I guess you can find out from the stockbroker.
You'll find out. Again, apart from stockbroker, a lot of this information is actually available on the stock exchange website, some on the company website as well.
Okay. Well, I've never seen a company pay dividend quarterly. I think the most I've seen is twice a year and annually.
Well, for those of us who are old, there was a time the likes of Mobil and Total, I'm talking about 25 years ago, they used to pay dividend quarterly.
Oh, wow. Interesting.
But for now on the Nigerian Stock Exchange, abroad you also find people who pay quarterly, but for now on the Nigerian Stock Exchange, the most that people do is twice a year.
Okay. So Ola says, isn't it possible for companies that were doing well before the economic turbulence to be unable to recover?
Absolutely, it's possible.
Yes, it's possible. So I guess
some companies would even collapse with the economy. As so you know,
it depends on the management of the company as well and governance, right?
It depends on a number of things: management, governance, and then also the financial strength of the company. Some companies are more financially strong. For example, It's just that you don't know it. Skybank is dead.
Wow.
From the viewpoint of investors, not from the viewpoint of depositors.
Okay.
Anybody that invested, put it this way, let's say 10 years ago, two people invested, one put 10 million in the shares of Skybank, so one put 10 million in deposit in Skybank. For the depositor, your entire capital and interest is intact. For the shareholder, your investment is zero.
Wow. So, but Skybank has never really been a strong bank, really. So, I guess.
Well, you see, I'm just using it so that people understand the fact that when it comes to investments, there is what we call investment risk. I need to understand it properly. It's not a one-way street. In fact, even for the good investments, it's not a one-way street because of the volatility. The price go up and down.
Okay. Someone says, why do you think companies give out bonus shares? Does this make the price cheaper on average, or why do they give out bonus shares?
Companies give out bonus shares because they don't want to pay out the money as dividend. They want to retain it. So for the shareholders to get a sense of we're getting something extra, it's like converting that dividend to bonus to shares. There are some companies that you actually have a choice as to whether you want to collect your dividend in cash or you want to collect it in shares. I think one company that has been doing that in the last few years is Stanbic IBTC Holdings. In the last about 2 or 3 years, every single investor had a choice between collecting the money in shares or collecting it in dividend. I know that in the past, yes, had also done that, but it's not. Well, in most cases, the company will give you your money. If you now want to reinvest the money, all well and good, go to the exchange and buy additional shares.
But I mean, but why do they give out bonus shares? Is it to increase their? I mean, why do you think they give out bonus shares?
There was a time the market loved bonus shares. Once you announce bonus shares, your share price will begin to go up, and institutions also. But in this under current conditions, you see it once in a while. We still see it once in a while, but it's not very common as it used to be.
Because I would think that it would dilute your shareholding.
It dilutes your shareholding, but it dilutes in the proportionately for everybody. So it's not as if you are damaging anything. It's proportionately for everybody.
Okay.
It doesn't dilute for some and does not dilute for others.
And if that company is increasing in value anyway, it still works out for you. Yeah. Ola says, can one list the essential services provided by the federal government? I don't understand your question, Ola, so I think you should just write.
I don't understand either.
So JKS says, there's really no point investing in the money market and treasury bills at this point because returns are lower than inflation rates. Well, short term, if you do want to, I mean, that's one thing Mr. Agusto said. A 90-day investment might be because you need the funds liquid for 90 days. So
let's say you want to use the money to pay school fees in 90 days time, please don't put it in the stock market, put it in the in the money market.
Yeah.
That one, at least your money is not going to go down.
Yeah, and it's still slightly better. I mean, it's better than a savings account, really. So even if you earn something small from it. So I think Chimedu, that answers your question now. So Chimedu says, is it advisable to invest in Euro bonds?
Yeah, it's also one of the ways by which Nigerian investors actually hedge against currency risk. They invest in Eurobond. Yes, it's a viable alternative. Another thing that has happened now is that because of everything that is going on, the yields on Nigerian Eurobonds, of course, when you are investing in Eurobonds, you are not limited to Nigerian Eurobond. You can invest in it. But the yields in Nigerian Eurobond has gone up because investors are saying that with oil prices going south, are we sure that the federal government will be able, they will have enough dollars to pay? So again, high risk, high return.
But the government cannot afford to default, right?
The government really cannot afford to default because if they default, it means that...
I hear Lebanon defaulted.
The reason that they cannot afford to default is because they need borrowing every year to run government.
True.
So if you now decide to default and nobody is willing to lend you money, then you cannot run government again.
Yes. Chimedu, we've answered your question. You can, companies can allow you to invest your dividend. Some companies do. You can just go back to the stock exchange and buy more. Nathan says, How much is good enough to start? I think that depends on you, Nathan, based on all you've heard. How much can you afford? How much can you afford to put in a long-term investment? Uchimere says, what is it? Sorry?
I think we should go on and have some concluding words. I think we've answered all of the questions by and large.
I just want to round up. I'll take Deborah's question last, and let me just round up these questions here now, then we can just round up. Uchimere says, what is a bull market and a bear market?
A bull market is when all the prices are going up, and a bear market is when all the prices are coming down.
Okay. That's a very simple way, but I think it captures it, yes. So Lukman says, is it possible to have a reduction in your share price after the company you invested in acquires another company?
It's possible. You see, the thing is that share price is a reflection of supply and demand. And there are several factors that reflect supply and demand. So yes, it's possible for share. In fact, not that it's possible. Share prices will always go down and go up.
Yeah. So I guess go on, please.
Go ahead. No, I think I've said what I want to say.
Okay. So I think Ola has explained her question for that. She was saying that basically there are always like a list of essential services in any economy. That can you say that because this company sells essential services, it's a good investment? I think that's one thing we've discussed here, that it's not necessarily always the case because there's good management, there's corporate governance, but I guess Mr. Agusto can take that as well.
Yes, but in addition, on top of all of those four things that I mentioned, you see, in investing and in real economy, when you are selling food, your performance or your sales is unlikely to be as cyclical as somebody who is a cinema. Because na person wey chop belle full dey go cinema, right?
Yes.
So there are certain industries that in investment terms they are called defensive industries. In other words, the impact of economic downturn on them is very, very muted. But the other side is that when the economy is also booming, the impact is muted. The example I like to use is that Dangote is the richest man in Africa, but his demand for toothpaste is the same as you and I, because he will not use a lot more toothpaste because he's very rich. But guess what? When it comes to private jets or luxury cars, his demand will be times 10 or times 20 any one of us. Right? So when you're talking about essential products, whether the economy is booming or the economy is doing bad, everybody will still use toothpaste. Everybody will use soap to take their bath. Everybody will drink Nestle water if that's what you drink, right?
Yes.
But whether economy is good or bad, I'm not sure that they will sell the same amount of Range Rover. Range Rover may even be high-end. They won't sell the same amount of Toyota Corolla.
Okay. But Mr. Agusto, but even if a company is selling essential services, if the company is not well managed as well, so
of course, that's why I said on top of the four things that I discussed.
Okay.
Selling essential products means you are in a defensive business.
Yes, so it's a defensive stock, but you still have to consider those factors.
All of us, is it all food items that we stocked up?
Yes.
Well, there are people who are thinking that, I need to buy even tire, talk less of a brand new car.
Yes. Yeah. Okay,
so when the chips are down, people will go for the essential. How many people have gone to cinema? If they open Disney after this pandemic, how many people are going to go to Disney?
It will take a while.
From Nigeria.
It will take a while. Okay, so final two questions. Deborah says, I can always add money to my principal. Yes, Deborah, you can increase your shares by buying more. Yes. Theresa, we would have to take that to Coronation. It's Coronation that can answer this question. So I think we're done. So we can go on with rounding up.
So let me move to concluding remarks. Okay. So the question is, what are the practical next steps?
Yeah.
Now, the first point I would like to make is that the foregoing examples that we have used are not the only good examples. There are also others, right?
Yes.
Also, we need to understand and appreciate the fact that it's possible to lose money when investing in shares. Getting the right expertise is key. I think the truth is that the average person the average, just an average person off the streets does not have enough skill to be for investment in shares. So that's why that's why coordination is there, for example, of whichever advisor that you want to use. Now, you also need to decide whether or not you even want to invest in stocks at all. Realizing that the best approach to investing in stocks is actually to view it as a long-term investment, right? You then need to decide how much you like to invest and the timing. Like I said earlier on, you can decide to do it in bits, right? And also periodically if possible. That periodically, you could also take the view that whatever income I get from my investment, I'll reinvest. Now, you then need to select a stockbroker or an investment app that you're going to use. On my phone, I have two investment apps. I have Trove and Bamboo. I'm not saying that those are the only two. Incidentally, those two, they don't limit you to the Nigerian Stock Exchange. You can also invest internationally if you want. A crucial point is to decide whether or not you have the expertise to select good investments or you need the services of a broker. Like I said, I don't think the average person has the expertise. Again, those four key attributes for purpose of emphasis: well-governed, well-managed, good track record, cheap price. Stock prices are volatile. We talked about that. I think I've reinforced that. And please, please, please get an advisor if you feel you need one. You cannot be too careful with your savings and investments. You cannot be too careful. So these are the practical next steps for most of you. Sorry, there's a typo here. Look at the way practical is spelled. Practical, sorry. Okay, so thank you very much. I don't know whether there are any, we can just take maybe just one or two questions in conclusion. If there are just one or two questions in conclusion, if there are any.
Mr. Agusto, do you use Bamboo and Trove?
I actually don't. I've downloaded them, but I've not really used them.
Oh, okay. I wanted to know because we have the CEO of Bamboo.
But I know people that do.
Okay. The CEO of
and Trove is actually partly owned by ARM.
Ah, okay. So I guess that gives you some good backing, basically.
Yes. Because when I downloaded them initially, I was also looking at these people, is my money safe also? But when I now heard that ARM was involved, it provided me with some comfort.
Yeah. And we have the CEO of Bamboo coming to do a webinar with us as well next 2 weeks. So
okay.
we ask all the questions for Bamboo. So people can keep your questions on Bamboo. We'll have the CEO come and answer that. All right. So please, I dropped a message. Please, if this webinar has been of value, just give us like a shout out on social media and everything. And of course, we'll send you emails for you to give us your feedback. Rotimi says, can we have the Excel sheet used earlier to calculate long-term returns? That seems to be something people always ask for, Mr. Agusto.
I would say, I don't know what to say really. But one thing I want to tell you though is that Excel sheet is not rocket science.
True.
It's not rocket science. Hold on. Is it showing?
Not yet.
Not yet. Just hold on. Is it showing now? Oh, sorry.
Yeah.
I want to bring it on. Just hold on. You see, it's not rocket science. The formula you have here is the internal rate of return formula. You can, okay, let me go here. You can see the formula here. It's highlighted here. You can see it. And even if you don't know how to do the formula, just Google internal rate of return or IRR formula using Excel. It's not anything, I can send, it's not anything proprietary, anything, whatever. It's just plain, whatever. It doesn't, and then this is a price today, dividend in 1 year's time. Just requires basic knowledge of Excel. Any other question or comments?
I don't see any other questions. We're rounding up now, guys. Question, put it in the next 5 minutes. So Yeah, they said they don't want to reinvent the wheel. They just want to use the Excel sheet. Well, you get access to watch this video again, so you can probably look at the recap on the Excel sheet you will do. We started with the Excel sheet from the beginning, so you see all of that again, right? EJ is rushing off to go and buy. Okay, she's gonna just be very careful. Ensure
somebody
that
is rushing off to go and buy.
just look at, because I know that, I mean, if we believe that the market has not bottomed out yet, maybe you should just be cautious in how you place your bids.
Yes, that's my own opinion, actually. I believe that if market has not bought, because that's also because I believe there's still negative economic news that's going to come out. And once there's negative economic news, people are going to say, they'll just sell and bring my money. I'm not doing it again.
I mean, one of the concerns I have for buying stocks on some of these apps is, are you actually buying the stock or you're buying into a fund? I think that's just a question that, I mean, because if I cannot walk into the NSE and claim that I have shares in this company because I bought on an app, then that's a concern.
If you buy on an app and it does not reflect on your CSCS,
Yes.
then it means that you didn't buy. Because your CSCS, just like your bank statement, is the evidence that you own those things.
Exactly.
And then, of course, the other evidence that you own is that the registrar will send the dividend directly to your bank account.
Exactly.
So it's not Bamboo or Trove that is going to be sending you the dividend.
Yes. So that's my own concern about the apps, which is why we always say that for now, buy through Coronation. We're working through Coronation, set up something online, because I've checked out one or two of the apps and I don't see them saying that I'm actually buying.
I'm sure with any stockbroker that is worth their salt today in 2020, the fact that you're using a stockbroker does not, you can do the stockbroking online. Any broker today in 2020.
Yes, you can. But just that some of them don't have this app. So if you're using an app, please ask questions. Ask questions.
Almost any broker today I'm sure that Coronation has.
Yeah, Coronation does. What I'm just saying is that for some of these apps, I mean, for the foreign stocks, you're actually not buying the stocks. You're buying into a fund, because you really cannot own those stocks if you do not have a social security number. So that's for foreign stocks. But if you're buying local stocks, you should also ask questions. Is this going to reflect in my CSS account? Do I actually own these shares? Am I going to earn dividend from it? I think that's very important.
Maybe just safer for you to use a broker. You can you're still going to work online. You don't need to go to the broker's office. You can buy and sell online.
Yeah, we know that Coronation is setting up something. We're working with them to set up something for that. So yes, that's one thing. But please, if you're buying from any app, please ask questions. Okay? Ask questions, or just do it directly through Coronation. You can buy it online through Coronation. It's very easy. I mean, because they've all been working remotely, it's been quite difficult to get access. But if you have an issue, just let us know. Let Lola know. We'll put you directly in touch with the top people. And as a member of the Green Club, you get priority access. Don't worry. Okay, so I think that's all for now. So I think we need to let Mr. Agusto go. Thank you so much, sir. It's been about 3 hours.
Thank you very much. Thank you
for
very,
sharing
very
all
much.
your knowledge and all your practical experience with us. We still will come back, because we are Oliver Twist. We'll come back to ask you for more stock recommendations.
No problem.
Hope you would oblige us, please. So yeah, thank you everyone for joining in this webinar. We will send you information on how to get access to this for a limited time. Some people do not start from the beginning, and some probably didn't even join at all. So yes, we will send you all of that information. So thank you so much, guys. Don't forget to give us a shout out on social media. And of course, share with everyone that they need to join the Green Investment Club. Yeah, so we are very okay. All right, so I think we'll end the meeting now. Thank you, Umfon. You're all welcome. Mr. Agusto, everyone is saying thank you to you.
Thank you to everyone.
You know
thank you.
There's all this kind of information at all. There is don't worry, it's me and you. There is right, we know that. I mean, because there's really no book on the Nigerian Stock Exchange. Maybe you need to write a book, sir. I can help you facilitate that.
Okay.
There's really no book on that. All right. Thank you so much, people. You're welcome, Olaimi, and Fon, everyone. Thank you. Thank you. Thank you. Thank you. Thank you. All right. We'll end the meeting now. All right. Bye, everyone. Bye.
Bye.
Oh, sorry. Mr. Agusto, are you still there?
Yes, I am.
Someone says you need to join the Green Club. You're already an honorary member, right?
I'm more than I'm a sponsor. What do you call patron?
Yes, so for those who
Patron.
don't know, Mr. Agusto was my very first boss, straight out of my NYSC. I got to work directly with Mr. Agusto. So all of the knowledge that you see me have today is because I worked with, you know what, by this.
All of the positive knowledge that she has. All of the positive knowledge.
Mr. Agusto, I don't have negative knowledge, please. I do not have negative knowledge. I mean, working with Mr. Agusto gave me a really fantastic foundation for all I do today. So please, that is one of the reasons why I knew that I had to bring him on. So yes, he's a patron. He's the honorary patron of the Green Investment Club. And we'll be sharing all our plans with you.
Tochi, thank you very much. Tochi says grand patron, not just patron.
Grand patron. Yes, honorary grand patron. Don't worry, Mr. Agusto will come and give you the honorary. In fact, we invite you for a special event.
No
all right,
problem.
Sir. Thank you so much, sir, for your time today. All right, people. Bye.
Thank you, everyone. Bye-bye. Bye.